Welcome to today's presentation on order block trading. In the world of finance, order blocks are an essential tool for traders looking to make informed decisions. By understanding what they are and how they work, you can gain an edge in the market and increase your chances of success. In this presentation, we will explore the basics of order block trading, including how to identify them on a price chart and different strategies for using them to your advantage. We will also discuss the importance of risk management and provide tips for minimizing your exposure to potential losses. By the end of this presentation, you will have a solid understanding of order block trading and be ready to incorporate it into your own trading strategies. Order blocks are areas of price consolidation that indicate a strong level of support or resistance. They are formed when large institutional traders place orders at a specific price level, causing the market to move in a particular direction. Traders can use order blocks to determine potential entry and exit points for their trades. By identifying these areas of price consolidation, traders can make more informed decisions about when to enter or exit a trade, and can also use them as a reference point for setting stop-loss levels. One way to identify an order block is by looking for a consolidation area on a price chart. This is where price has moved sideways for an extended period of time before breaking out in one direction or the other. The high and low points of this consolidation area can be used to identify the order block. Another method is to look for areas where there is a significant increase in volume, indicating that there is a large amount of buying or selling activity taking place. These areas can also be used to identify order blocks. One popular strategy for trading with order blocks is to wait for a breakout above or below the block. This can indicate a strong movement in one direction and provide a good entry point for a trade. Traders may also use multiple time frame analysis to confirm the strength of the breakout. Another strategy is to look for confluence between order blocks and other technical indicators, such as moving averages or trend lines. This can provide additional confirmation for a potential trade and help traders identify optimal entry and exit points. When it comes to trading with order blocks, risk management is crucial. While order blocks can provide valuable insights into market trends and potential entry and exit points, they are not foolproof. It's important to have a plan in place for managing risk and minimizing losses. One effective strategy for managing risk is to use stop-loss orders. These orders automatically trigger a sell order if the price drops below a certain point, limiting your potential losses. Additionally, it's important to keep an eye on overall market trends and adjust your trading strategy accordingly. By staying informed and being proactive, you can minimize your risk and increase your chances of success. In conclusion, we have learned that order blocks are a powerful tool in trading that can help identify key levels of support and resistance. By understanding how to identify and use order blocks, traders can improve their entry and exit points, as well as minimize risk through effective risk management strategies. It is important to remember that incorporating order block trading into your strategy takes time and practice. However, with patience and dedication, the benefits of this approach can be significant. We encourage you to start exploring order block trading and see how it can enhance your own trading strategies. Thanks for watching. Like and subscribe, and we will catch you on the next one.